Welcome back to the channel. Today we're diving into Grab Holdings Limited, a company that has become a household name across Southeast Asia and is now catching the attention of investors globally. For anyone unfamiliar, Grab is not just another tech firm. It's what people call a super app, meaning it integrates multiple services under one ecosystem. From hailing a ride to ordering your favorite meal, paying bills, sending money, and even managing digital banking services, Grab positions itself as an all-in-one platform for daily living. In 2025, the company has already made headlines as its stock price has surged roughly 30% year-to-date, bringing it to around $6.25 per share. That's no small feat given the economic uncertainties that continue to swirl around global markets. But with every rally comes the inevitable question, will this momentum last? Or could Grab's share price just as easily slip back to $4? That is the central debate investors are grappling with right now. And unpacking both sides of this story requires us to dig into the numbers, the competition, and the broader challenges of operating a multi-pronged digital business in emerging markets. To start, let's establish why this recent rise is even notable. Grab has historically faced skepticism from Wall Street, largely because it's been difficult to prove that the super app model can translate into consistent profitability. Revenue growth has been robust in the past, but expenses have consistently chewed away at potential earnings. In 2024, Grab reported a gross merchandise value, GMV, essentially the total value of transactions conducted on its platform, of $7.9 billion. Out of that, revenues came in around $2.2 billion. These are impressive figures, but what matters to investors is not just scale, but growth relative to that scale. Compared to its early days of breakneck expansion, Grab's growth rate has slowed to the mid-single digits. This isn't catastrophic, but it raises doubts about whether the company can re-enter a faster growth phase or whether it has matured into a lower growth business with thinner profit margins. Ride-hailing, once Grab's crown jewel, is recovering, but not as rapidly as bulls would like. Food delivery, a business that boomed during the pandemic, has moderated now that consumer habits have normalized. And fintech, despite being heralded as the next big opportunity, remains more of a burden than a profit driver. Now, let's put valuation under the microscope. At $6.25 per share, Grab trades at roughly 3.5 times forward sales. When you compare that with Uber, which commands a higher multiple, Grab does look undervalued on the surface. However, valuation multiples aren't awarded in a vacuum. They depend heavily on investor confidence in a company's ability to expand margins and achieve profitability. If Grab's revenue growth stalls in the mid-single digits and its fintech arm continues to post losses, then the market might not be willing to assign such a generous multiple. Instead, investors might compress that valuation closer to 2x sales. And if that scenario unfolds, the math paints a different picture. A fair value closer to $4 per share, significantly lower than where it sits now. That's why the current price feels like a crossroads, either validation of a recovery story or a temporary rally before a pullback. This is where the bull and bear narratives collide. On one hand, bulls argue that Grab has already weathered some of its toughest storms. Regulatory hurdles, intense competition from Gojek in Indonesia, and the post-pandemic recalibration of consumer demand have all tested the company, yet it's still standing strong. Margins have been improving gradually, and the adoption of digital banking products across Southeast Asia could open up new revenue. Southeast Asia's demographics also favor Grab, with a young, increasingly urban population hungry for digital-first solutions. If the company can successfully leverage its ecosystem to cross-sell financial services and retain users through loyalty programs, today's valuation could look like a bargain. A move from $6.25 to $10 or even higher isn't outside the realm of possibility in such a scenario. On the other hand, bears raise valid points too. The fintech division, while promising, is currently a money pit. Building trust in financial services, especially in regions where banking penetration is uneven, requires significant investment. Unlike ride-hailing or food delivery, which scale relatively quickly, digital banking involves regulatory approvals, compliance costs, and the constant risk of defaults or fraud. Add to that the reality that Uber, DoorDash, Sea Limited and regional players like Gojek aren't standing still, and Grab faces stiff competition on multiple fronts. If execution falters in even one of its core verticals, investors could quickly lose patience, dragging the stock downward. At $4 per share, the market would essentially be signaling doubt in the profitability of the super app model, suggesting that scale alone isn't enough without efficient monetization. The risk-reward setup here is fascinating because Grab's story isn't just about financial metrics. It's also about narrative. Investors love a compelling growth story, and the super app model has a natural appeal. Who doesn't want a single app that can handle transportation, dining, shopping, and payments all in one place? Yet, as China's super app giant Meituan and even WeChat have shown, these models work best in markets with a high tolerance for monopolistic ecosystems. Southeast Asia, by contrast, is fragmented across countries with different languages, regulations, and consumer behaviors. What works in Singapore may not easily translate to Indonesia or Vietnam. This regional fragmentation adds another layer of complexity to Grab's execution risks, something that may not always be reflected in the simple price-to-sales multiple. As investors weigh their options, it's worth looking at what has happened in broader market trends. The Trefis high-quality portfolio, for example, is a great benchmark of how disciplined stock selection can outperform indexes like the S&P 500, Russell, and S&P Midcap. Since its inception, that portfolio has returned over 91%, which underscores the advantage of carefully curated companies with both growth and resilience. Grab, by contrast, sits at a more speculative end of the spectrum. While it has the potential for outsized returns, it also carries meaningful downside risk if the execution narrative falters. This isn't necessarily a reason to avoid the stock. It simply means that investors must be clear about their own risk tolerance. Unlike the smoother ride of the HQ portfolio, buying Grab is more like boarding a roller coaster, exhilarating when the stock climbs, but stomach-churning when it dips. At this stage, the takeaway is clear. Grab at $6.25 represents a recovery story that could swing in either direction. The path to $10 relies on stronger margin improvements, better monetization of fintech services, and consistent execution across its ecosystem. The path back to $4, meanwhile, would likely result from slowing growth, widening losses in digital banking, and a loss of investor confidence in the sustainability of the super app model. For long-term investors, the bet comes down to whether they believe Grab can truly transform its market dominance into a self-sustaining profit machine. When thinking about Grab's future, it helps to place the company in the context of Southeast Asia's broader digital economy. The region has one of the fastest-growing populations of internet users in the world, with millions of people coming online every year. This digital boom is driving demand for services that can simplify everyday life: transportation, food delivery, e-commerce, and payments. Grab has positioned itself at the center of this ecosystem, often being the first app downloaded on new smartphones across several Southeast Asian markets. That stickiness gives it a unique competitive advantage. However, it's important to remember that being a first mover does not guarantee long-term dominance. Competitors like Gojek in Indonesia and Shopee under Sea Limited have proven adept at challenging incumbents, and even global giants like Uber and Amazon are eyeing Southeast Asia with growing interest. This raises the stakes for Grab. It must not only maintain its market leadership, but also evolve fast enough to fend off rivals who are equally hungry for growth. Another critical factor is the changing regulatory environment. Southeast Asia is not a monolithic market. Each country has its own rules, regulators, and political dynamics. In some cases, governments encourage digital innovation by easing restrictions, but in others, protectionist policies or concerns about monopolistic practices can create roadblocks. Grab's ride-hailing operations, for instance, have occasionally been scrutinized for pricing strategies and driver treatment. Meanwhile, financial regulators are extra cautious when it comes to digital banking licenses. The company's ability to navigate these regulatory landscapes will play a large role in whether it can achieve sustainable profitability. One misstep could slow growth dramatically, while consistent compliance and collaboration with regulators could help build trust and unlock new opportunities. Investors also need to examine Grab's margins more closely. A business model spanning ride-hailing, delivery, and fintech inevitably comes with higher operating costs than single vertical competitors. Subsidies to attract and retain users, marketing campaigns, driver incentives, and the cost of maintaining a digital financial infrastructure all eat into profits. While revenue has been climbing steadily, the real question is how much of that revenue can ultimately flow down to the bottom line. Investors have been waiting years for Grab to show clear signs of profitability. If the company can continue to trim losses and demonstrate operating leverage, confidence in the stock will grow. On the other hand, if fintech losses keep ballooning, any gains from ride-hailing and delivery could be offset, leaving investors frustrated. One encouraging development is that Grab has been making progress in increasing user engagement. The company has expanded its loyalty program, Grab Rewards, which encourages users to stay within the ecosystem by earning points that can be redeemed across services. This kind of ecosystem strategy is critical for a super app. The more touch points a user has within the app, the harder it becomes for them to switch to a competitor. If you rely on Grab not just for transportation, but also for your daily meals, bill payments, and digital wallet, then the switching cost rises considerably. This stickiness is what bulls argue will eventually give Grab a defensible moat, something that will justify higher valuation multiples in the future. Still, skeptics are not convinced. They argue that ecosystem stickiness only matters if the services themselves are profitable or on the path to profitability. Creating loyalty by offering discounts and rewards is costly, and if margins remain razor thin, then loyalty does not translate into shareholder value. This is why the conversation always circles back to margins and execution. Even if the user base continues to grow, Grab needs to prove that it can extract more value per user without relying excessively on subsidies. That transition, from growth at all costs to profitable growth, is the defining challenge of this stage in the company's evolution. For retail investors considering whether to buy into Grab today, the decision hinges on risk tolerance. At $6.25 per share, the company is not prohibitively expensive relative to peers, but it is also not cheap when you factor in the execution risks. The upside case to $10 or beyond requires a combination of strong regional growth, effective cost control, and successful monetization of fintech services. The downside case to $4 stems from slowing momentum, competitive pressures, and persistent losses. This makes Grab a classic high-risk, high-reward stock, appealing to investors who can stomach volatility, but less suitable for those seeking steady, predictable returns. This brings us to an important comparison with something like the Trefis high-quality portfolio. That portfolio has significantly outperformed benchmarks over the past 4 years, not by chasing speculative plays, but by focusing on a balanced selection of companies that deliver consistent returns with relatively lower risk. It's a reminder that while speculative opportunities like Grab can be attractive, they should not form the backbone of a well-diversified portfolio. Instead, they can complement a portfolio, adding potential upside while core holdings provide stability. For long-term investors, having that balance is crucial. Relying too heavily on a single-story stock, no matter how promising, can expose one to outsized risks. Looking ahead, 2025 and beyond will be pivotal for Grab. The company's ability to deliver consistent quarterly improvements will likely dictate whether the market assigns it a premium valuation or discounts it further. Every earnings report will be scrutinized for signs of progress in narrowing fintech losses, expanding ride-hailing margins, and boosting delivery profitability. Positive surprises could reignite investor enthusiasm, while disappointments could quickly erode confidence. In volatile sectors like tech and digital services, sentiment often shifts faster than fundamentals, amplifying stock price swings in either direction. Ultimately, Grab's story is one of potential versus proof. The potential is massive, a super app that integrates transportation, food, and finance in a region with hundreds of millions of young, digital native consumers. The proof, however, is still incomplete. While revenues are rising, profitability remains elusive, and competition is fierce. For investors, this duality creates both opportunity and risk. The stock could double if execution is flawless and adoption of digital banking accelerates. Conversely, it could just as easily retrace to $4 if the company stumbles. This is the essence of investing in emerging market tech stories. You're betting not just on financials, but on the management's ability to execute and adapt in a fast-moving environment. For anyone considering grab, the best approach may be moderation. A small position can give exposure to the potential upside without jeopardizing the stability of your overall portfolio. Meanwhile, keeping an eye on key performance indicators such as GMV growth, margin improvements, and fintech profitability will help you gauge whether the company is delivering on its promises. The ride will likely be bumpy, but that's par for the course with disruptive, high-growth companies operating in rapidly evolving markets. So where does that leave us? At $6.25 per share, Grab is a stock at a crossroads. Optimists see a recovery story that could lead to $10 or higher, powered by regional growth and ecosystem stickiness. Skeptics see a fragile model weighed down by thin margins and heavy competition, with a path back to $4 not only possible but probable. The truth will likely unfold in the middle ground, where execution, regulation, and consumer behavior intersect to shape Grab's destiny. For now, investors should remain cautious, stay informed, and above all,